Hello all. Welcome to video 9 of chapter 3. In this video, we're going to be discussing stock option benefits. Now, stock option benefits have to do with the ability to purchase your employer's stocks at a preferred price. So you often get a discount from what they're available for on the market. So there's a benefit here. We're not going to go right into the slides because I think going through the slides can be confusing at first. So I'm going to go right into an Excel first to hopefully give you an idea of how the stock options work, just, with numbers. And then we'll go to the slides to discuss the theory. Then we'll go to the exercise. So when we deal in stocks, we are concerned with capital gains. So capital gains are what did we pay for a stock? And then eventually what we sold them for, that's the capital gain, and that's only included 50% in income, standard capital gains. The thing is, we got a discount, we got a benefit on our stock price because of our employment. So if we were, let's say there's 1,000 shares and we had an option, our stock option says we can buy shares at $10. To buy 1,000 of them, we paid $10,000, but we got $12,000 worth of shares because the fair market value was 12. We paid less than what we got. So that difference of $2,000 is considered the employment benefit. That difference of $2,000, that discount we received, is going to be added to our employment income because that's money we didn't have to cough up. We didn't have to pay it, so we have a benefit. We saved $2,000. We have $2,000 in our income. That fair market value price becomes our cost base. Even though we paid $10,000, we recognize the difference in income. So our cost plus our employment income equals our cost base. So our cost base is still the fair market value. So if in a year we sell it for $23 a share, that's $23,000. Our capital gain is 11,000. That 23 minus the 12. 50% inclusion, $5,500. So we paid $10,000. We got $23,000. 5,500 is taxable capital gain. $2,000 is employment income. So of that $13,000 we received, 7,500 will be taxable. I'm going to talk about the concept of in the money when we get to the deduct. There's a deduction related to this, but I don't want to jump to it just yet. Yes. These are the steps in the stock options. We're worried about the grant date. So let's go to the slides, get through some of the theory. And when we're discussing the potential deduction, I'll come back and discuss why the value of the options at the grant date are so important when the exercise date is often what we're concerned with. Okay. So stock option benefits. The Section 7 of the Tax Act establishes that stock option benefits are part of employment income. It's a preferred price because I work there. Income Tax Act 110 talks about a potential deduction. Stocks, if they're recognized as a capital gain, are only included 50% in income, but the stock option prices are 100%. The deduction allows us to convert that 100% inclusion back to only a 50% inclusion, but it's very dependent on certain factors of your grant date for the options, and we'll get into that soon. So an option to buy a share is defined at a specified price for a specified period of time. You work for the company, so we're going to give you a $5 discount on the stock shares for 2 years. That's called, the timing's called vesting, but I'm not going to worry too much about the nomenclature. But it's supposed to provide incentive for employee performance. Because I have the option to buy a share at, say, $10, the higher that share price gets before I exercise the option, the more valuable that option is. So startups are really big on providing share options because they're at the ground floor. We want to get more customers. We want to design a new product. And in 1 to 5 years, that value could skyrocket. So if everyone else was able to get on the bottom floor at $10, if that share price goes up to $50, you've improved your position. Since employees can control the amount of effort and time they put into developing the product, they can in turn increase the value of those options. So when you are granted the options just say you can buy the share. There's no tax benefit at this time. It's not until you physically purchase a share did you actually get something in return. I bought it for 10, I got $15 back. That's a measurable benefit. But when the options are available, nothing's happened yet. So the granting of the options does not create a taxable benefit. With no benefit, there's no tax deduction for the employer. It's different from accounting procedures where an expense must be recorded by employer when options are granted. Since I'm giving the employee the option to buy a share at a discount, regular accrual rule says, well, they've now earned it. You have that obligation. But because stock options affect taxable income in the employee, we don't worry about the expense until the employee exercises the option. So we don't worry about the expense until they include it in income. So the stock option benefit rules. These rules normally applies to add the fair market value of the right to purchase the share, but is overridden by Tax Act 7. So Tax Act 7 determines the value for stock option benefits. No benefit is added to employment when stock options granted. If stock options are granted to an employee slash shareholder in the capacity of a shareholder, then the Section 7 does apply, benefit treated as income for property. We don't get into in this course the benefits for shareholders. Our focus is on employees. So the important thing to remember is granting a stock option, not yet a benefit. So value at issue, so we care about 3 points in time. We care about what was the value of the option when it was granted, what was the value of the option when it was exercised, and what was the sale of the shares. So we care about grant date, exercise date, and the selling date. So at issue, there's no deduction to employer, no income inclusion for recipient. Employment income inclusion, the amount added to employment income is determined when exercised, when you physically buy a share. So the benefit amount is the excess. How much more was the fair market value over the exercise price? Now, fair market value will always be more than the option price because if I can buy a share of Google at $15 and my option price is 20, why would I spend more? Why would I buy it for $20 when I can just go get it for 15 from someone else? So I would only use an option price if it was below the market rate. The share's $15, my option price is 12. Hey, I can get a discount. I will buy from my employer. A reasonable investor would always take the lowest price they can get, right? So whenever we exercise options, it is 99% of the time always lower. Our exercise price is always lower than the fair market value of the share received. So employment income inclusion, when it's recognized, is different for public and CCPCs. When you buy the share of a public company, so I've exercised my option, say for Google, that employment income gets recognized right away. The reason for that is because there is an open market for those shares. So shares are 15, I buy it for 12. I go to my employer and I say, I'll take that $12 share. In the same day, I can now sell that share for $15. So I can realize that benefit at any time. So I recognize the benefit when I buy the share. The thing about private corporations, if they're not traded on a market, finding someone who wants to buy your share is a much larger, pardon me, endeavor. It's not so easy to find a buyer, and private sales are very different than market sales. So I got it. So the share's worth $15. I bought it for 12. There is a benefit, but I can't realize that benefit yet. I can't convert that share to cash. So I'm not going, so if I exercise an option for a CCPC, I don't have to recognize that employment income until the share gets sold. So for a public company, employment income recognized when purchased, CCPC, employment income recognized when sold. That's the big important aspect of these two types of corporations. Taxable income deduction. So the stock option benefit is 100% included in employment. Taxable income deduction equals half the stock option benefit. And it's the result is only a portion of the benefit is subject to income tax. So stock option benefits are 100% included in income, but you can deduct that to half, 50%, under certain circumstances. Do we go into it? When do we go into the deduction? Not for a while. Okay. We'll go into the rules for it soon. After I have the share, I've recognized the employment income. Any further sale, capital gain or loss, is treated the same as a normal share purchase. So we recognize our cost base is that fair market value, that 12,000. So whatever happens at the selling price, that's treated as a regular capital gain or loss. So we're really only concerned about the timing between the option price and the fair market value at the exercise date. The cost is equal to what I paid for it plus the employee benefit. The employee benefit's always the difference between what I paid and the fair market value at option. So the cost base will always be the regular fair market value of that share. Canadian controlled corporations by public corporations benefit included employment income when exercised. CCPCs benefit included income when sold. And I've already gone through that. So rules for public corporations. The benefit equals the excess of fair market value on exercise date minus what you paid to acquire it. The stock option deduction is only available if at the time the options were granted, the option price was equal to or greater than the fair market value of shares at that time. There's no deduction if the option price is less than fair market value. So let's get into what that's saying. There's a concept called in the money. It's going to the steps, it's looking at the option price when granted. So let's say this option price was $42.50. I can buy a share for $42.50. And the fair market value when I'm granted the option is $45. The day they gave it to me, they gave me this option and said, hey, you can get a discount right now. It's called in the money. If it's in the money, that share immediately has a value. It's already a discount. The day they gave it to me, it's valuable. I didn't have to wait. I didn't have to worry about the market. I didn't have to, work extra hard to get the price of the company up. It was valuable from day one. Because it's in the money, I don't get a deduction because the deduction treats the shares as if it was a capital gain. But capital gains relies on waiting out the market. When does the value, hoping the value goes up. But in the money means I already have value. If the fair market value price was less, let's say it's only $40, now it's not in the money. Now my option price is more than what it costs to get a share. So I have to wait. I have to invest my time and effort into the company, hoping that fair market value goes up. And by doing so, now when I exercise it, I'll get that deduction. That deduction comes into play when not in the money. But if there's an immediate benefit in the money, no deduction because there's no playing the market. So as an example, on December 31st, 2021, John Doe receives options to buy 10,000 shares of an employer stock at $25. It's a publicly traded company. Shares are trading at $25. So my option is market price. All options are exercised on July 31st, 2024, about three and a half years later. When shares, oh no, December 31st, about 2.5 years later, when shares are trading at $43. Mr. Dew sells all shares September 30th, 2025 for $45. So it's a public company. So we're going to recognize employment income when exercised. There's no tax consequences at the grant date. There never is. But on the exercise date, the employment income, we got $43 per share, but we only spent 25. So for every share we bought, we got $18 of value, right? We only paid $25. I got 43 back. My value went up $18 just from exercising it. So $18 for every share, and there's 10,000 shares, $180,000 is my employment income. But my stock options were not in the money. They were equal to the fair market value. So my option price equaled fair market value. There's no benefit. The benefit doesn't occur until that fair market value goes up. So because I have to wait for that fair market value to go up, I get a stock option benefit for half of the employment income. So 180 gets added, 90 gets subtracted. So my taxable income, my employment income for the stock option is 50% of the calculation. So it's almost like it was a capital gain. When we disposed of it, so that happened in 2024. So it's a public company. In 2024, we included income of 90,000. In 2025, we sold the shares for 450. Our fair market value when we exercised was 430,000. So our capital gain's only $20,000. Half of that, we have an income inclusion of 10. So in 2024, we added 90,000. In 2025, $10,000. For CCPCs, it's very similar. So the option price is equal to or greater than fair market values to get the deductions. Or there's an or here, or we can just hold those shares for 2 years. CCPCs sometimes take time to sell. So if we have the shares for 2 years, that price could have gone down, or maybe we couldn't find buyers or something happened. So because we held it for long enough, we're still exposing ourselves to, say, market forces. So we can get the deduction if we hold them long enough. So similar concepts. The only thing that's different is it's now a CCPC. So the solution, no consequences on grant date. That income inclusion of $180,000 is calculated on the exercise date, but won't be added to income until we actually sell the shares. So the stock option deduction is not available until the shares are sold. In September 30th, the shares are sold. So before, our income was broken up between 2024 and 2025. Now, because it's a CCPC, it's all happening in 2025. That's when we sold the shares. So inclusion rate half, we have the $180,000, $10,000 from our capital gain, from our taxable capital gain. Total income is 190, but we do get the deduction because the option price was equal to or more than the fair market value. So let's take a look at an example. In October of 2021, Mr. Musa has granted stock options to buy 2,500 of his employer's share at $23 per share. At this time, the shares were trading at $20 per share. So our option price is more than the market price of the share. So we're not in the money. That means we'll be able to take a deduction when we exercise them. This is a public corporation. So Mr. Musa's employer is a large publicly traded corporation. In July of 2025, we exercised the stock options that were trading at $31.50. We paid $23. In September of 2025, the shares were sold for $28. What's the effect of the exercise of the stock options and the sale on the 2025 net income? Identify the two amounts separately. So we care about the price at grant because we want to know if we're in the money or not. Since the option price is more than the fair market value at the grant date, we're not in the money. That means we're going to get a deduction. The option price, the fair market value of the shares was $31.50, and we bought 2,500 shares. When we multiply those numbers together, we got $78,750, but we only paid $57,500 for it. So we have to recognize an income, $21,250. Because our grant date was not in the money, we get to deduct half. So in 2025, our employment income will increase by $10,625. When we sold the shares, that's treated as a regular capital gain. The sale price is $28. Our cost base is the 78,750. It's based on the fair market value when we exercise the shares. So 78,750 minus our sales price of 7,000 is a capital loss of 8,750. So our allowable capital loss is half of that, 4,375. We won't be able to subtract this allowable capital loss unless we have taxable capital gains from elsewhere in the tax return. But assuming we do, that gets added to employment income. This gets subtracted from our taxable capital gains. Looking at another example for CCPCs, don't know why it does that. There we go. In December of 2023, Miss Villy Van was granted stock options for 1,800 shares at a price of $42.50. At this time, the shares have a fair market value of $45 per share. So they are in the money. The fair market value is more than our option price. Miss Van's employer is a CCPC. In June of 2024, the shares have a market value of $75 per share. That's when we bought them. In September of 2025, the next year, Miss Van sells her shares for $88,200. That's $49 per share. What's the effect of the exercise and the stock options and the sale of the stock option shares for 2024 and 2025 net income and taxable income? So I have the breakdown here, but it's similar to these steps. $42.50 was the option price, but they were valued at $45. So as soon as they're granted, we are in the money. Since we're in the money, we get no deduction. The option price, we paid $42.50 on the exercise date, but we got back $75. So for every share, we made $32.50. So the employment income is $58,500. $32.50 times 1,800 shares, I think is what we were. Yeah, 1,800 shares is what's in the question. So that's our employment income. But because this happened in 2024, because the company is a CCPC, we're not going to include the employment income until the shares are sold. That $75 becomes our cost base, that fair market value at purchase. So $75, we sold them at $49 per share. That's a loss per share of $26. The total capital loss was $46,800. Our allowable capital loss is half of that, $23,400. So we'll have an employment inclusion of $58,500 and a allowable capital loss deduction of $23,400. Again, allowable capital losses need taxable capital gains to subtract. So this is the actual exercise solution, and it follows the same numbers. 135, 135,000 for 1,800 at $75. 135,000 is what we received. We paid 76.5. Income inclusions are going to be that 58,500. Our in the money test says we don't get the deduction, but we could have still gotten the deduction if we held the shares for long enough, 2 years. But we didn't. We bought them in 2024, sold them in 2025, only a year passed. So they were held less than 2 years. So we're going to recognize the full amount in 2025 when the shares are sold. When it's sold, that cost base of $75 per share, it's still treated like any other capital distribution, creating an allowable capital loss, 23,400. There's a restriction to the reduction. That 50% deduction is restricted for companies that make lots of money. Federal government issued new restrictions to provide support for new and emerging companies. Stock options kind of are meant for startup companies. You tie the employee's value of the options to the growth and success of the corporation, and that helps everyone work together to build it up. but they found that very valuable corporations were offering stock options to their executives in ways to help get that 50% deduction. So we have people who are already millionaires getting given millions of dollars worth of stock options and only being taxed and being able to deduct 50% of that value. So they're getting tons of value, but that's not being included in income. So the government says, well, it's not really meant for those very valuable public companies. So restrictions do not apply to CCPCs. This is something that applies to public companies, and the company needs to make more than $500 million of gross revenues. So this restriction only applies to a public company making $500 million in revenue. Employees of non-CCPCs of gross revenues greater than 500 million can still claim the stock option deduction, but they're restricted to an annual limit of $200,000 per each employer individual employee works for during the year. So they said, okay, when you have these stock options, you only get this deduction for like the first $200,000 worth of options that are granted to you. So that's to keep them from exaggerating excessive stock options of millions of dollars. You only get the deduction on the first 200,000. So if they give you $1 million worth of stock options, you don't get the deduction for the other 800,000. I'm going to say this is a bit complicated. I don't think we give you any questions, but just to round out the discussion of stock options, I'm going to go through the exercise solution. So employer can claim taxable income deduction equal to the part of the stock option benefit included in income that relates to non-qualifying shares. So how does this work? So remember, this is a lower priority for your course. If it gets too confusing, focus on the other share calculations. Miss Baker is a senior executive employed by Supra, a multinational, publicly listed corporation with gross revenues over $1 billion. In September 2023, Miss Baker's granted a stock option plan that allowed her to purchase 27,000 of the company's common shares for $27 per share. The terms of the plan allow her to acquire all the stock options beginning in December 2024. So they gave her the options. They need to vest for a year and then she can exercise them. The common shares were trading at $22 when the stock options were granted. So the grant price has it in the money, or not in the money. The options are at $27, market value is 22. So we need to wait for that value to come up. We're not yet in the money. So a deduction is allowed. We're just restricted because of the size of the company. Miss Baker exercises all options in December 2024 when the value of the shares is $35. She sells all the stock options in April 2025 at a sale price of $41 each. Indicate the tax consequences that took place for 2023, 2024, 2025. How would your answer change if only half the options were available in 2024? So what's the difference? Because we have this $200,000 limit, annual limit, what happens when all of the shares are available in 1 year? What happens if we split it over 2 years? So there's two exercise solutions here. What we have to do is we have to figure out the qualifying shares to benefit from the deduction. So the total number of share options is 27,000. So at the grant price of $22, the fair market value of issuance is $594. So 200,000 divided by the fair market value. So 200 divided by 594. That's how much, that's the fair market value of shares that were available at grant date is 33.67%. So we'll apply that percentage times 27,000, and it says 9,090, or rounding it off to 991, are qualifying shares. That's how many of the shares can benefit from the reduction. The rest of the shares cannot. So these shares add up to 27,000. So the stock option deduction, when we exercised, it was $35 minus the option price of 27, that's $8. So $8 times the number of qualifying shares times 50%. So times 8 is 72 times 50%. is 36,000. So that 36,346 represents how much can we deduct. We can deduct that much when we sell these shares. So when we sold all the shares, we got 945,000, we paid 729. Our full employment income was 216, but we can only deduct the portion of that price or of that value that related to those 9,000 shares. So our income inclusion is 179,000. When we sell the shares, that's treated like any other transaction. So how is this different when we split up the vesting? The fair market value of issuance at grant date is now only 297. See, we split up that 50%. So now we have these two shares happening. The calculation will end up at the same number of the same value of the deduction. The difference is we get it twice. We get this 36,000 for the 2024 shares. We get it again for the 2025 shares. So if we consider all of the shares together, our increase in taxable income inclusion is going to be 71,000 in each year. So 71,636 times 2. Our total income inclusion for both years is 143 compared to 179. So the difference between 143 and 179 is that 36,000. So by splitting up the vesting of those granted shares over years allowed us to get 2 years worth of allowable reduction. So we got that calculation, but we're allowed to use it twice. If this is confusing to you, don't worry about it. Focus on these calculations, but just establish that if you are a very large corporation, you can get the deduction, but you don't get all of it. You're limited to that 200,000 per year, $200,000 per year. So to show this calculation, 200 divided by 297, now we have a much larger portion, a much larger percentage rate, 6734, but we're only applying it against half the shares, 13,500, instead of the 27,000. We only have access to half of them in the year. So that gets us to the same number. Okay. Thank you for your time. Employee stock options is a big subject. I know we're over 30 minutes for this video. When we come back, I have a couple other smaller other inclusions to talk about. And then I think we're going to talk momentarily about employment expenses and home office expenses and what we can deduct from all of our employment inclusions. Thank you. See you in the next video.